Signs of a pandemic recovery are beginning to emerge. Restaurants are reopening, airlines are increasing flights, and financial firms are lending again. That means opportunities abound for small business owners looking for funding, but not every small business loan will be right for you. There are criteria and qualifications you need to meet. The last thing you want is to apply for a loan only to be rejected. Josh Jones, Chief Revenue Officer at Kapitus, the online lender, is here to demystify small business lending for us. He knows all the ins and outs and secrets to getting a loan. Thanks so much, Josh, for taking out the time today. We really appreciate it.
Absolutely. I'm glad to be here.
So signs are emerging. We're starting to see the economy turning a corner. Businesses are looking for money. Lenders are out there lending. Give us a state of the environment. Is it easy to get loans, or is there capital available, and who's getting it?
Yeah, for sure. There's definitely capital available for businesses. From the lending side, we've actually seen reduced demand in more of the traditional products that we'll cover today. For us, it's been interesting. A lot of businesses were either in the category that they've done very well during the pandemic, maybe even some better than prior to the pandemic, at a reduced expense, because when this all happened, everybody tried to cut expenses, and they didn't really need capital. They had this great cushion, and if they did, they should have, or still have, taken the funding options that were provided from the government, whether it be the PPP loan or the EIDL. Now, there was another category, unfortunately, that did not do well. We've seen those applications of businesses that really did struggle a lot due to some of the state restrictions that really prevented specific businesses from doing well during this time. But those businesses, in the cyclicality of an event like this, they didn't make it. But what we are seeing now is, as lenders, we know that there's this really great time to lend money, and that's where there is this pent-up demand. And we know businesses are really going to have a lot of success on the way out, whether it be with their business-to-business clients or with their consumers. And if they did well during the pandemic, we're very much ready to lend to them. So there is that access to capital, that more traditional line that's not the pandemic, version of capital that's been offered by the government.
Great. So when we talk about small business loans, there's a lot of different types. There's conventional loans, there's SBA loans, then there's alternative lenders like yourselves. SBA loans seem to be like the ones experts say you should go to first. What's the deal with them? Are they easy to get outside of PPP? Are there SBA loans right now, or that's kind of shut down?
Yeah, I think the only reason it may have been difficult for somebody if they've said, hey, it was difficult to get an SBA loan, was because a lot of the banks were overrun from applications for PPP and EIDL. But as far as I'm aware, and I don't think there's been any official statement, that SBA loans are available just as they were prior to the pandemic. And there's three main SBA loans. One is the 504 loan. That one is really used for financing commercial property that's owner occupied. So it's basically a mortgage for you to, if you're renting in a building and want to take over the building, it really gives you great access to that. Then you have an SBA 7A loan, which is, as the government defines it, used for some more risky categories of uses. And that's it, even though some of the lines have been blurred on that. But it's really for inventory, refinancing debt, working capital, growth, maybe even to buy a business. That typically will require real estate as well as the collateral. And then you have SBA loans under $350K, which I think are really not known by most businesses or understood by most businesses, that there is this category of SBA loans that doesn't require you to have real estate. It will require you to have very strong financials. But I really see it as a huge benefit that's really not talked about enough, and not many banks offer it. But the option is there that you can get a $350K or less loan without real estate as a business. And all of those loans, I would always look at lending as you go to what may be the easiest and most cost-effective first, and all the way down. And that's why people look at the SBA. They know it's government-backed, and lenders can offer a cheap rate.
What's the knock against it? Is it the paperwork and the time for funding? Is that what the biggest knock is?
Yeah, I think that's right. It takes anywhere from 4 to 6 weeks to get a typical SBA loan. So typically when you need money, you already needed it a few weeks ago, and now you have to wait another 6 weeks. So it creates this really like long timeline for somebody who needs some instant needs. When I say cheap rate, it's all relative. The SBA's rates are somewhere between 6 and 13%. And sometimes it's also accompanied with a 1 to 4% origination fee by somebody helping you to get it. It's called a servicing fee, actually. So when you look at the combined rate, it definitely is expensive to some extent, but all money is expensive. So I'd ask, anytime I talk to a small business, I try to tell them that, we've been programmed around mortgages and seeing these low single-digit rates. It's not really available for a small business. So I do think, the timing is the biggest issue. I think some people do have some sticker shock. They're expecting like mortgage rates on something that doesn't carry a mortgage rate.
Great. Then we have conventional loans, which are the ones you get from banks and credit unions. Are they popular, or are they not as easy to get as SBA loans?
So they're not as easy to get because the government backings are one step removed, right? So it's now a bank is giving their money and it's not insured in any way, which is, I guess it's relative to a borrower only because it says, what are your odds of getting approved for this? And because it's also not government backed, rates can actually go from anywhere from 7% to 30% over roughly 1 to 5 years for a conventional loan. Because now as a lender, they build in rate to make up for the bad payers. Really, it's always about good payers always take the brunt of the bad payers. It's just how lending works. And but it's a great option if you're looking for something in that 1 to 5 year mark. The dollar amounts can go pretty high, as they can with the SBA. But we're almost talking a little in a subjective line of what is subjectively a bank like, and that's in a small business, and that's different from bank to bank. So whether it's an SBA loan or a conventional loan, you may have success at one bank or another. And even though I told you about the servicing fees that an originator or a broker may charge, that 1 to 4%, if you do your proper job as a small business and really vet your originator, they can be worth their weight in gold because they know how to navigate that environment. And banks typically have good relationships with certain originators, and they can help you maybe move the process a little bit faster because they want to appeal to that originator to continue to get them to send business their way.
So now, online lenders, they seem to step up and give small businesses loans when banks may not. They're quick, they fund you quicker, they don't require as much collateral, maybe more leeway with the credit score. Why is that? Why are online lenders able to do that? And then what kind of products are we looking for in that realm?
Yeah, absolutely. So I think, the main reason that online lenders are willing to do that is because it's all about rate plus like how long somebody has with the capital, right? So, online lenders entered the space giving very short-term loans. And in a short-term loan, less can go wrong in a short term. So you're able to give more money to what would be considered a riskier borrower. Now, at Kapitus, a lot of our borrowers actually are very similar to what a conventional loan applicant will look like, or an SBA applicant. Just for instance, a lot of our borrowers are around 700 FICO and 7 years time in business. But you nailed it with what you said about speed of funding. We can give somebody capital in 1 to 3 days, and we can go all the way up to really $1 million in that funding. So just as we kind of started with, when you need money, you're already 3 days behind or 3 weeks behind. It really is important to a small business who's trying to be, the owner of that small business is trying to be the CEO, the CFO. He's trying to be the head sales guy. And all of a sudden, when he needs money, he's looking at the bank account like, wow, I have all this opportunity. I need money for it, and I'm too late. So we're able to give that short-term need. The other big thing is, as an online lender, we're really not looking at collateral. So, the collateral is the business. It's the revenue of the business. It's not what real estate do you have, what assets do you have. If we're lending to a toy store, there's really no value in the teddy bears that they have on the shelves for us. And we're not worried about that, but a bank's going to be like, those teddy bears aren't worth anything to me. So, our terms started in online lending as very short term. Our terms go out to about 3 years now, soon to be 4 and 5 years with Kapitus specifically. But the online lending space, when you look at the cost to borrow, total cost of the capital has actually, it can be relatively, I don't want to use the word cheap, but it doesn't have to be a lot because we give a lot of incentives to pay back a loan early. So if you look at total cost of borrowing, I'd say we're very much opportunistic capital. We try to help a business. flip inventory, grow, if it's a restaurant, add tables, that those tables instantly increase the revenue, and you're able to pay us back early and get that discount.
When it comes to online lending products, what are the most popular with small businesses?
Yeah, I'd say most popular within small businesses are the standard. There's a few names for it, but a standard, business loan, factoring agreement. What that means is we're really factoring your revenue. So we're saying based on your revenue, we'll give you X dollars over a fixed period of time. And if you pay it back any sooner than that fixed period, we discount you based on the month sooner you pay back. Now, there are line of credits that are. Line of credit has been kind of an overused term in my mind for the last 5 years. It is also just a fun fact. It is the most Googled financial product from small businesses on Google. When people think of money, they just naturally put in LOC or line of credit for my business. And there's a lot of artificial line of credits, but really I think what that represents is more flexible abilities to borrow and pay back. But it may not come with the higher approval amount up front. Because if I was to give a small business 100K, say pay me back in 12 months, that's one thing. If I give you 100K in a line of credit, it's only available to you as fast as you pay back. So if you pay me 50,000 back of that 100K, you can borrow that 50 again. But I have to be aware all the time of how much money I'm giving that business, even over a period of time. So those are pretty the two top and as far as what an online lender offers. And there's everything in between, but those are the main categories.
So going back to the speed in funding, why are you guys quicker than banks? Is it because it's a short-term loan and underwriting is different, or why are you guys so much quicker?
The way we look at we bring in a lot of outside sources initially to give us a really good feedback on the business, right? Which a lot of banks aren't doing. We front that cost up front to make sure we can either get to a fast approval or a fast decline, and that's everything from FICO, the business score, and business score really takes into account the history of a business's ability to pay back debt, right? So. Are they paying on their trades? Are they paying on their vendors? Have they borrowed before and doing really well? We use that, and then a bunch of other variables we're pulling from these online databases. And for us, the financial aspect is really it's the conclusions drawn from the bank statements. And we all either are leveraging third parties or we've kind of built our homegrown internal methods to review bank statements or log into a bank and extrapolate that data. And for us, I mean, that's everything. We can come to a decision within a few hours because of that method and be comfortable. I think even more comfortable than most would assume going out to that 3, 4, and 5 years.
So for small business owners who are looking for funding, what are your secrets or top tips to get that money quickly?
So I'd say, definitely my secret is to look for money way sooner than you think you're going to need it. And I truly mean that genuinely, not from somebody who represents sales or wants to grow sales at a lender, but when you think you need capital, it's probably the right time to apply, and everybody waits. And the reason you thought you needed that capital was because something, either there was an impediment coming up that was going to require you for that capital, or it was an opportunity. And when either of those hit, it can put you at a cash flow disadvantage. And like I just said, I'm reviewing your bank statement. So all of a sudden, we see this decline in cash flow. You may be preaching to everybody, I have this amazing opportunity, but we're not seeing that. It actually looks like your business is going the opposite direction. And I hate that, but it's, you can't take a chance on someone's word that says, hey, like I have all this coming up. So I'd say make sure your business is in that financial stable position when you apply. The other thing is that a lot of businesses don't really think about what they're doing in their personal life and how that it can affect their business. And listen, on everybody's FICO score, based on what you report your earnings are every year, there's a utilization rating, and it says how much debt have you utilized as an individual based on your income. And that's the same for small businesses. So I know it may be, you may come into money and you may want all these things, or you may want to buy a new boat or a new car, but whether it's whether it's a debt that came out of nowhere recently, and we can see that spike in debt that you took on as a person, or you're carrying a lot of personal debt, it will impact your business, because as a lender, we might not be able to triangulate what that debt's been used for. And then the last thing is, I'd always say, if it's possible, and I know it's not always possible, for a business to keep reserves, some type of cash reserve. And it's not, it will help in some instances to get an approval if they're carrying a better bank balance. And even if that business is not going to use that money for whatever need or opportunities there, it's great to have that cushion when you borrow, because in case you can't make a payment, you can pull out of your reserves. But the lender is going to look at that in most cases very favorable.
This was awesome. This was really, really informative. So I want to thank you so much for taking out the time today.
Yeah, no, thanks for having me. It was great. If you ever need anything, I'm available.